David, great to have you back on the show. We had some new numbers here which just came in this morning. International trade came in at $53.1 billion. Your reaction to the number here that just got released?
Well, the trade goods in the deficit, it rose month to month from November to December, $1.6 billion or 2.3%. You know, you have to ask yourself this, Ben, is the trade deficit, is it political or is it fundamental? You know, I personally think it's more of a fundamental issue. And, you know, President Trump, he's trying to make America great, and he was in Davos recently talking about that and what that would entail. But we opted out as a country out of the TPP. And because of that, the other countries didn't wait around for the United States. 11 other countries recently signed agreements, and they're going to finalize those agreements in Chile on March 8th. And that is really causing America to take a seat back in international trade. So I think you're going to see the rising numbers of trade deficits in America in the short term until there's a major change in probably either our currency or wages, because for us to compete internationally, Ben, we got to get our wages down, and that's not what America is about right now. We've had wages not keeping up with the cost of living for the last decade, so I think we're going to see wages continue to rise. Therefore, I think you're going to see trade deficit rising.
Yeah, and if anything, it would seem like the Fed's going to be pushing for higher wages. But let's talk about the fact that yesterday we thought we'd see a bid come into gold with the weakness that we were seeing in the indices, but that flight to quality seemed to be somewhat muted relative to what we were seeing in the bonds. Do you expect that to change if we see continued weakness? Should we watch for the bid back in gold?
Well, you know, the previous high was 1363. Last year in 2017. I think we're going to test those highs again. We were about ready to rip your face off in the gold market per se. It was getting ready to break through. If we move past 1375, $1,400 will be right around the corner. I don't see that happening in the short term, but the LBMA came out with their analysts, the 34 analysts forecasting gold. They're saying the average cost of gold in 2018 is $1,318, $1,120 is the low, and $1,510 is the high. So I don't know if we're going to see those numbers. Whoever the upside, the higher analysts are, I like what they're saying, but I'm going to be a realist. I'm going to be a little bit more conservative than that. Bear in mind, though, this is the Chinese New Year. We head into the second week of February, which is a huge purchasing for gold by the Chinese, which is a major support for the jewelry side of the market. But I think really this is about a Fed play. You know, central banks, Ben, have just ballooned their balance sheets, $14.6 trillion, the highest it's ever been in history, 14% higher than the 2007 levels. And I think that's really what's going to cause gold to move higher as they unravel their balance sheet, and the Fed is saying they're going to do that. So this is really about, you know, affecting the markets. And bull markets don't die of old age. They get affected by what central bankers do, and that's what this is all about. It's causing havoc in all the markets. And I also believe that the markets are testing new Fed chairmen as Jerome Powell was brought into office on Monday. This is testing his leadership skills. Yellen was tested. Bernanke was tested. This is just a normal environment. Plus, we haven't had a 10% correction for some time. So we're going to see these volatile markets once we get past all the choppiness of the market. And I think we're going to be there in the next towards the end of this week, maybe even as earlier today, we might see the markets start to normalizing in their volumes. But I think it's going to be more towards the end of the week. And when we get to that, I think all the fundamentals are going to come back into play. We're going to probably see a little bit of a lower dollar movement. Right now it's strengthening. We're going to see a little bit higher prices in gold. 1330 is a big level of support. We're slightly above that. It's kind of testing in a $10 swing level. We got to get past the 1363. There's a lot of resistance there.
Yeah, I think Jerome Powell someday will write a book, and it'll be a pretty interesting first day as chairman of the Fed. That said, now, when we're looking at the dollar, and you're exactly right, the dollar is pretty sharply higher this morning, about up 0.4%. How is that going to, at the end of the day, is that going to be the strongest effect on the gold market, or is it going to be a risk-off? So far, it hasn't jumped on the risk-off bandwagon that we've seen with VIX and we've seen with even bonds. So is the dollar really going to be the main driver for gold?
That's the one thing I'm watching, Kevin. And you're exactly right about Jerome Powell. That book is going to be something else when it comes out. But back to the dollar. The dollar is really the king, and that's what this is all about. It's affecting all the prices of the markets. Everybody's looking at what the Fed is really going to do. We're going to have 3 rate hikes. Actually, we might even have 4. One Fed president alluded to that last week. I don't know if we're going to have 4. I think it's going to be more like 3. But we're going to see some choppiness. It is about the dollar. I think the dollar is going to go back into the normal fundamentals. We had a decrease of the dollar 9.6% last year. Gold went up 12.6% in correlation of that. I think we're going to get back to those normal trades where the dollar to gold correlation will impact what happens in the world. Obviously, all metals are affected. Even copper has been affected by the dollar. So we're seeing some problems in the short term here. We'll get past all this, and then we'll get back to the normal fundamentals, how trades are being placed.
All right, you mentioned gold and the impact that we're seeing as far as the dollar trade. You mentioned copper. Let's talk about silver, back down below 17. It's a bit under pressure here right now. What's behind the selling that we're seeing in silver?
You know, silver's kind of the redheaded stepchild. We came so close, like I said on the last program, to having a high-ho silver moment where we were going to have a breakout in silver. It's been on a 7-year downward trend, stuck in a channel where people haven't been able to make money in it unless you were a short-term trader and you were very good at predicting the swings in silver. I just don't see a big demand happening in silver. The supply is definitely there, contrary to what some people say in my industry. So I don't see a big movement in silver. But once gold starts moving, silver is going to get brought up on it. Silver didn't do very well last year, only up 6%.
So obviously we're seeing futures lower again this morning in a very extremely volatile trade. So the fact that gold is not participating so far, is that a signal that this is a short-term sell-off in the overall stock market? Or are we watching for gold to start to participate as kind of a red flag?
Well, that's a great question, Kevin. You know, when you look at the history of when we have these sell-offs in equity markets globally, not just in America, but this is a global phenomenon happening right now. Typically, the first 3 or 4 days, even a week, gold doesn't do much at all. When we look at what happened in 1987, gold didn't move up the first week. But in the next year, it moved up 35% while stocks didn't do very well. And a hedge fund was set up on Wall Street that captured a whole bunch of money. It wasn't a large hedge fund, about $100 billion, Kidder Peabody, that set up, in essence, physical collectible coins that drove the market up 200 to 600% in 18 months. I don't know if we're going to see that again, but my industry really did like it back in 1989 and 90. So what we're seeing here on a fundamental side is gold is operating like it normally would, Kevin. It's not it's not moving into a let's jump on the fear bandwagon, because this is not a fear trade happening right now. I think that will happen next year when we see the yield starting to move. Recently, we saw the 10-year yield pull back to 2.8% or 2.78%. We actually was 2.83 at the high, and then it pulled back recently. So once we start to see the Fed unravel their balance sheet, the bond market become more of a bubble, and Bill Gross has been talking about that, also Jeffrey Gundlach, we see those things where they're forced to unravel their balance sheet, $2.5 trillion in U.S. securities, and the Treasury has to issue more treasuries to support the $1.5 trillion budget deficit that we're creating, along with other debt added onto this. That's when the fear side of the gold trade will come into place, but we're not in that environment yet. This has not triggered that. I will say this, though, Kevin, if we have 4 or 5 more days of what we saw on Friday and yesterday and possibly today, and there's no recovery today, we see 4 or 5 more days moving forward in this, then the fear trade of gold will come into place.
4 or 5 more days, the Dow will be at 10,000, David. But let's move away from the talk about the ES Nasdaq Dow Russell, because when I think about metals this time of year, I'm not thinking so much about futures, because you've got like we've got the Super Bowl. We've got the Lombardi Trophy, which, you know, is quite shiny. We have the Olympic gold medals, silver and bronze medals. So I start thinking about metals in terms of a little bit of a different light here. Talk to us a little bit about the Lombardi Trophy, about the Super Bowl rings, the silver and the gold component in the gold medals.
Well, you know, why you have to ask yourself the question, why is something historic made out of precious metals. It's been with us for over 6,000 years. It's woven into our society, and athletes are awarded with such. You know, looking at the Philadelphia Eagles, they're celebrating not only with the trophy, but the rings they're going to get. Historically, Super Bowl rings were created by 5 different companies that designed the rings. The average cost is around $36,000, although recently, last year, there was 283 diamonds on the ring that the Patriots, representing the third quarter. If you remember, the score was 28-3, so 283 rings, a huge comeback by that team. They had to put that in the ring. There's a lot of value in those diamonds. Of course, it's surrounded by platinum. That's how that ring was created. Onto the trophy, the Vince Lombardi Super Bowl trophy. You know, that trophy was created on a napkin in a restaurant. It is $1,400 in silver value, about 7 pounds. But the holding of it is much more valuable than the $1,400, along with the Super Bowl rings. We're going to see the same thing happening when we get into the Winter Olympics.
All right, ladies and gentlemen, David Fischer coming at us from, he's the founder and CEO of Landmark Capital, coming at us again with some good insight and thoughts in terms of metals. David, thanks for coming on the show here today.